This audio is brought to you by Business Radio, powered by Wharton.
From the campus of the University of Pennsylvania Wharton School, this is Your Money on Business Radio, powered by the Wharton School. Here is Professor Ken Smetters.
Hello and welcome. You're listening to Your Money here in Sirius XM's Business Radio, Channel 111, that's powered by the Wharton School. And I'm Ken Smetters, a professor here at the Wharton campus in Philadelphia. And remember, we are live every Tuesday from 5 to 7 p.m. That's 2 to 4 for those of you on the West Coast. And the purpose of this show is simply help you make better decisions with your money. And we often, in the first part, focus on ways to increase your productivity and your income. And the rest of the show, we typically focus on ways to wisely spend and save that money, including things like paying down debts, buying insurance, and of course, how to invest your money. And really, the most fun part of the show is that we take your calls throughout the entire show and give you advice about your own financial needs. Remember, you can connect with me online by going to my website, kentonmoney.com. I have a growing list of fee only. Remember, you always look for fee only, not fee-based, but only fee only advisors who have also pre-screened in addition for my approach to low-cost passive index investing. So today I'm joined by three great guests. The first will be in studio, Tom Meyer, who's the CEO of Meyer Capital Group. We often have him on the second or third segments to answer your calls about financial planning. In this case, we're going to have him on the first segment to do some year-end planning, a little checklist that maybe you should run through before the end of the year. And then later in the show, you know the routine by now. I'll have a couple of financial planners with me taking your calls about your own financial situation. First will be Laura Mattia, who is the managing director of Bay Point Wealth Management. She focuses on how to inspire women to become more financially engaged. But of course, we welcome calls from both genders about anything related to your finances. And then later in the show, I'll have Garrett Prom, who is the founder and certified financial planner of Prominent Financial Planning. He often focuses on the kind of the Gen XY, but nonetheless, again, all these folks are generally trained, are willing to take your calls about anything related to your own personal finances. So if you want to know how to invest your money, save for your retirement, your kids' college, life insurance, maybe someone's trying to sell you, budgeting, paying down debts, really, maybe grandma just left you $100 grand, you want to know what to do with it, really anything about your money, that's the show's name. Remember, live on Tuesday, so give us a call here at 1-844-WHARTON. That's 1-844-942-7866, and we'll talk about your own situation. Remember, you only have to give us your first name and the state that you're calling from, so never a reason to be nervous or shy, and thousands of other listeners will benefit hearing the advice given to you about your own financial needs. So my producer, Michelle, is standing by and ready to line up your calls, so give me a call here at 1-844-WHARTON. That's 1-844-942-7866. With that, let me introduce my first guest, Tom Meyer, who is the CEO of Meyer Capital Group in Marlton, New Jersey. And again, like all financial advisors on the show, he is fee only. In fact, his firm was one of the early fee-only firms started by his grandfather a long time ago. And he's been a 5-star advisor rating with Palladian Registry, often quoted in major media outlets, Dow Jones Newswire, Barron's, Investment News, and many others. Welcome back to the show, Tom.
Ken, always a pleasure.
And if you have a question for Tom, especially about year-end planning stuff, give us a call here at 1-844-WHARTON. That's 1-844-942-7866. So, Tom, let's go through a kind of a checklist of things that people maybe want to think about doing. The first one is you talk about tax loss harvesting to avoid capital gains. Explain that.
Yeah, very important this year especially. You should go through your portfolio if you have any dogs or losers or dogs with fleas, if you will. Might as well take advantage of that to offset any capital gains you might have. Yeah. Especially on the mutual fund side, we are seeing the potential of huge capital gains being paid out at the end of the year. Double-digit payouts that we haven't seen in a long, long time. So if somebody either has a portfolio of mutual funds and stocks and has some losses to take, you might want to really evaluate your portfolio to try and offset those gains, capital gains that will most assuredly come, unfortunately.
Yeah, and it's more to potentially avoid surprise. And I think it's important, and once a year I used to do something with the Wall Street Journal on tax loss harvesting, and one of the points I would try to emphasize, though, is that sometimes I thought the tax loss harvesting gets a lot of attention of tax alpha and so forth, but people have to remember when they, in fact, are selling their losses and selling their gains, they're also resetting their basis. Essentially, they're deferring a tax bill. It's not like they're avoiding paying taxes.
No, not at all. And one other thing to consider too, if you're an individual investor, maybe you bought a mutual fund 30 days ago, you might want to check with that fund, because if that mutual fund is going to pay out 10 or 15% in capital gains, it might actually pay to exit that fund temporarily, whether you have a little gain or a little loss. And then, that is to avoid a capital gain payout for the individual investors that were in there for the full year. You would hate to pay their taxes that you've only been invested in the last 30 days.
Yeah, absolutely.
Very important.
Yeah, and the second thing is you talk about deferring income to reduce your current income tax. Explain that one.
Well, if you have some year-end bonuses that you may be able to defer, by all means, you might want to take a look at that. The other side of that, of course, is to look at income that if you are in even a lower income base, not only to defer it, but increase it. I know it's a little bit oxymoron there, but if you have for instance, if maybe you lost your job and you're over the age of 59 and a half and you're in a very low income, it might pay to actually take from your qualified plan before you get another job the following year, which will also help offset some taxes going forward.
Yeah. And if, in fact, this tax cut goes through and marginal tax rates go down, all the more reason to want to maybe income shift toward next year to take advantage of the lower tax rates. Of course, that's betting on a political outcome.
We have not a clue.
Yeah. It's interesting. There's certain products that actually trade in the stock market that you can back out what the implied probability of the tax cut going through. And that probability has risen from like 15% to over 50%, but nonetheless.
And but which one's going to? Is it going to be the Senate, or is it going to be the Congress?
It's definitely going to be the Senate because of the Byrd rule. I mean, that's going to force them to kind of go with the Senate. I view the House one as more a representative of desires rather than what they could actually get done.
So that means that we'll basically have 7 tax brackets.
We'll probably have definitely not the simplified in the House.
Nothing simplified about this.
No, that's right. And what's really scary about it, I run the Penn Wharton budget model. We do all the analysis of the macro effects and so forth. And there's a lot of uncertainty about we take into account a lot of this income shifting. We just talked about income reclassification, but there's a lot of unknowns still that tax lawyers are going to really figure out of gaming the system. Okay, so by the way, Knowledge at Wharton, their show tomorrow morning, we'll talk about these issues. I'll be on the show, and David Kamen is a tax lawyer from Columbia. We'll be discussing those issues. The third issue, Tom, that you talk about is in-kind stock transfers for charitable deductions. And so talk about that.
Yep. So if you have low-cost stock and you want to go ahead and gift to your charity, do it in stock instead of cash. You alleviate the tax bill. You feel good about it, and you don't pay taxes. Yeah.
And I an article this week in the Wall Street Journal. I think they just told me a few minutes ago it just went behind the paywall. Did not know that was going to happen, but nonetheless, is on using a donor-advised fund because, I've been doing that this year. I'm packing a lot of my contributions into a donor-advised fund this year, even though I'm going to make some of the actual disbursements next year.
It's a great vehicle, and it basically you have enough on your plate for year end with the holidays and families, whatever. Put it into the donor advised fund, you get your immediate deduction, and then in 2018 you can divvy it out as you see fit.
Yeah, and what's really important, if there is in fact a tax cut going forward, we're in the higher tax bracket today, is putting in a lot additional money into a donor advised fund. This year gets all the money that goes in you take the tax cut this year, and even though you distribute the money kind of next year.
I like that. You said tax cut. You meant tax deduction.
Yeah. What's that?
You said tax cut. You mean the tax deduction.
I'm saying
if the tax cut goes through. Right.
If the tax cut goes through, then it's better to make the contribution this year, take advantage of the higher marginal tax rate that you're in.
No doubt.
Yeah. And so, but in any case, in fact, that's what your point there in the donor advised funds is that it's certainly useful for that purpose. And now, generational gifting. Explain what that means and how can you avoid capital gains taxes?
Well, it's the same scenario, right? You're giving away to either your grandchild or you're giving to your child, nephew, niece, whatever the case may be. You get it out of your estate and you go ahead and you're gifting a lower cost stock.
Yeah.
And then it goes into then they inherit your cost. And when they go ahead and sell that stock, let's hope they're going to be in a lower tax bracket.
Yeah. I mean, it's really smart because they're going to be almost certainly on the lower tax bracket if they go to sell a stock for college or whatever that they're going to do. So explain, you could also be hit with a gift tax. Explain how that works.
Yeah, we all have the gift tax. You're allowed to have $14,000 per spouse per child, or $28,000 combined. Which, by the way, does go up next year, which is very important, up to $15,000 per spouse per child. And you have the ability, without affecting any gift tax deducting from your gift tax on the estate tax, you have the ability to give away $28,000 in any form that you want. That's
right. And what's really important about that when you're donating or gifting, I should say in this case, a stock to your grandkids, something like that, that is $14,000 this year, $15,000 next year, will be assessed on the fair market value of the stock. So don't just look at your cost basis.
No.
You want to look at the fair market value of the stock. So they do inherit a tax bill, but at the same time, they inherit a lot more money than what's needed to pay that tax bill, and they're going to be in a lower tax bracket anyway.
It's a great gift. I mean, they have the potential to grow even more if they hold on to it.
Yeah, especially if they just sit on it for a while.
Sure.
So Roth conversions, how does that play into the end of the year?
Well, what's very interesting about Roth conversions is that you have the ability to go ahead if you meet the income requirements to take X amount of dollars from your IRA and to convert it to a Roth, and then also recharacterize that. Mm-hmm. However, under this new proposal, recharacterization goes out the window.
Yeah.
Which is pretty important. I mean, so personally, I think it's the right thing to do. I never agreed with it. I mean, you made a mistake. Guess what? It's like, I bought a stock at 40 and now it's at 20. I want to do over.
Yeah. No, I agree. I think it's one of those things in the tax. There's lots of elements in the tax bill that actually make a lot of sense. Some of those things aren't going to actually raise a lot of money, as it turns out, but nonetheless. So just to summarize that one, the idea is that you're going to potentially go from a regular IRA to a Roth.
Yes, there is no income limitations on that, by the way.
That's right.
You can go ahead and do that no matter what you make. Obviously, there are a lot of controversy, debate on whether or not is it right, is it wrong. A lot of people went ahead and accelerated the Roth conversions 3 years ago, thinking they'd be in a higher tax bracket, and it never did happen.
Yeah.
And the government, basically, you accelerated paying taxes to the government.
Yeah.
So it's a tough one.
Yeah, it is. So it really comes down to if you think the tax cut's going to happen, you're going to be in a lower tax bracket, maybe a reason not to do it. But on the other hand, if you happen to be in a lower tax bracket today, and you think you're still going to be able to
take advantage of it.
Higher tax bracket next year, even after the tax cut.
It doesn't have to be all or none.
That's right. So if you think you're going to be in a lower tax bracket today, even after the tax cut, if it goes through next year, then might as well do the conversion today, especially if you think by retirement you're going to still be potentially in a higher tax bracket. Well, a lot of people are. Okay, so again, speaking with Tom Meyer, he's the CEO of Meyer. Sometimes it's Meyer or Meyer.
Get it all the time. Or the yes. So Myers, Meyer, or Meyer.
Meyer Capital Group, and you've been on the show like what 7-8 times at this point. You're a regular at this point, and he's again Meyer Capital Group in Wharton, New Jersey. And again, if you have a question for us, especially about year-end planning, give us a call here at 1-844-WHARTON. That's 1-844-942-7866. And so now let's talk about 529 plans. Why is that so important year-end?
Well, first of all, you're getting money out of your estate, especially if you're a grandparent. It's a great gift to give for higher education only, although there are plans now possibly to use for lower education. That should be interesting. You're able to go ahead and do, again, your gifting of $28,000. However, what makes this interesting is you can accelerate this by 5 years and give a total of $140,000, which is basically a 5-year acceleration at one fell swoop. But here's another interesting...
And I would take advantage of that now. We never know where that's going in terms of tax reform.
This is true. But here's what's interesting is that next year it goes to $15,000 per spouse, which per child, or let's see, that would be $150,000 over a 5-year period. So I would think about making your normal gifting for the 529 this year. Don't accelerate this year. Accelerate next year, and you'll get an extra $10,000. Yeah.
It's a good point in order to take advantage of that. And even though we're talking about Roth and 529 plans right now, you might say, "What's the big panic?" Hey, year end, I can wait till April, but that's actually not true for the strategies that we're talking about right now. April is when you can just fund a Roth or a regular IRA for the previous year.
That's correct. And if you're going to try and set up a SEP or an individual 401k, these accounts have to be set up, but you can fund. It gets very confusing.
That's right. And a lot of these other strategies where it's talking about, you can't wait till
year end.
April. You want to do it year end. Okay, so finally, not finally, but the next one related to IRAs as well is taking distributions. You say taking them early can be a smart thing to do year end.
Yeah, I hit upon that earlier. If you're in a situation where you are basically in between jobs and you have a nice chunk in an IRA, you can actually take X amount, make sure it's under that tax bracket so you don't go over the tax bracket. That will reduce your IRA, which means it will further reduce your required minimum distributions when maybe you might be in a higher tax bracket.
Yeah.
Normally, I wouldn't even think about that, but in some cases we have run into this where it makes sense.
Yeah, because later on you're going to be hit potentially if you have a large IRA with a very large required minimum distribution.
Which can put you into another tax bracket.
You might be in a big tax bracket at that point. The government wants its money eventually.
And they want it now.
Yeah, that's right. They want within the 10-year budget window so they can account for it, and they don't care what happens after the 10-year budget window. So just to summarize there again, it sometimes makes sense, especially if you're in a lower tax bracket today, you're above age 59 and a half, tap into that IRA today. That reduces the corpus, and that's going to reduce the required minimum distributions, but that's typically when you're talking about a very large IRA.
Correct.
And so you're another point that you write about is you say taking your IRA required minimum distributions to avoid 50% tax penalties. Really important. It's a technicality that can hit you big if you forget it.
Huge.
Yeah.
And if we always take out more of the RMD or required minimum distribution than required just to be safe.
Yeah.
Because for every penny that you do not take out, that could be a 50% tax penalty.
Yeah, it's an enormous tax penalty because essentially what the government's basically doing is if you have a traditional IRA, they're basically, you didn't pay tax, you put in money after tax, you didn't pay taxes along the way. They want their money at some point, so they force you, according to a mortality table, to take out some RMDs. And if they only charge you your income tax as the penalty, then you would have incentive just to gamble, and just not take it out if you don't want to, because you're going to pay the income tax either way. So they have to jack up the penalty and
to give you incentive to go ahead. I mean, they're not all stupid in Washington.
No.
That actually makes sense.
No, when it comes to getting taxes, they're not dumb.
See, they're smart about that. Come on.
At least on the current. Well, no, I'm just kidding. All right, so again, speak of Tom Meyer, CEO of Meyer Capital Group, Marlton, New Jersey, and again, we're talking about year-end planning checklist. And then two last ones is certainly reassessing portfolio risk and rebalancing. I mean, obviously, it's good it's always good to do that kind of any time, but this year has been a particularly spectacular year.
It feels great. It's awesome, especially in 401k plans. Take a look on a rainy Sunday and reevaluate where you want your goals are and what your investment risk is, because more more than likely you will be maybe 20% overweight in equities, probably. I'm just saying on average, the way the market's been. Have to use a little bit of discipline. It looks great on paper, but there's nothing wrong with taking a few shekels off the table.
Yeah, and it's really importantly here is on tax-deferred plans like 401k, 403bs, people say, but if I do that, I'm going to realize all these capital gains and so forth, but that's explained. That's not important there.
The key is tax-qualified plans. Yeah. You could do whatever. Believe me, I'm not promoting trading, but this is just smart rebalancing. Bring the portfolio back to the allocation where it should be based on your risk tolerance and your investment objectives. Yeah,
and so when they tax deferred plan like a 401k, there's really no reason not to do it. There's not a tax liability. Now let's talk about a taxable account. What's kind of the rule that you guys use? Maybe it's more than a simple rule that you don't want to rebalance too much because first that can create actual taxable capital gains. You may also convert long-term to short-term gains and so forth. At the same time, if you get too out of whack, you just gotta bite the bullet and get back into balance here. So what's kind of the
you can't let the tax tail wag the dog. Yeah. Because to your point, I mean, I go back to the days when people had huge positions in Lucent. Oh, I can't pay any gains on Lucent, or I can't pay any gains on Cisco at 95 until it was at 16 and they were willing to go ahead and... No, you don't want that. I mean, you have to do it in a disciplined fashion. Yeah. But just because you're going to pay a little bit of taxes, which will be capital gains, which will more than likely be lower than your ordinary income, it's a smart thing to do, but it doesn't have to be done all at once either. You just have to be cognizant of it. You just can't let your portfolio sit there and not do anything about it. It's a living, breathing organism, and it has to be attended to.
Yeah, yeah. And so then finally, you touched on it a little bit, but you say also reviewing, current and needs and future goals. Explain that.
Look, you have hopefully a budget, a financial plan, goals-based plans. It's a good idea to basically upload all the new data in there to see whether or not you're going to attain your goals and make sure that you're within your budgeting. Look, unfortunately, the holidays, people go a little bit crazy. So you want to make sure that you're still within your original goals.
Yeah, fantastic. Tom, fantastic job. Once again, thanks for coming in and driving from New Jersey in studio. Yep. Thanks for coming.
Thanks, Ken.
And we're going to take a quick break. And by the way, you can find Tom online by going to his website, Tom. It's Meyer, MEYERCG.com. Again, Meyer. CG.com. It's also on my website, KentOnMoney.com. And you're listening to Your Money and Kent Smetters Business Radio here on Sirius XM 111, live every Tuesdays from 5 to 7 p.m. Eastern, repeated throughout the week. When you come back, the routine by now. I have a couple of financial planners with me taking your calls about your own financial situation. So if you want to know how to invest your money, save for retirement, kids' college, buying life insurance, really anything about your finances, your money, that's the show's name. Give us a call here at 1-844-WHARTON. That's 1-844-942-7866. And remember, you don't have to give us your first name, the state you're calling from. So just give us a call and we'll answer a question about your own financial needs. Again, 1-844-WHARTON. That's 1-844-942-7866. So go back to the phone lines right after this quick break.
For more guest interviews, check out our Wharton Business Radio Highlights podcast on iTunes and Google Play.